Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have John Quealy, Chief Investment Officer of Trillium Asset Management, to discuss if a recession is fully priced in. John, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me.
You got it. So let's talk about employment for a moment here. Metrics continue to show resiliencies. At what point, if at any, do you expect to see a recession?
Well, currently we're expecting in the back half of 23 to the front half of calendar 24. Remember, we're only about 14 months into the Fed hiking cycle. So 500 basis points in a year. This economy hasn't encountered that before. So it will take some time, but that still is our base case of a slowing economy with recessionary conditions into the first half of next year.
And what about the impact of the regional bank turmoil?
So it was certainly a first salvo, just about right on the 1-year anniversary of the Fed coming to raise some rates. We do think regional banks show the first signs of stress, and they certainly have. Here, we had not significant exposure in our domestic strategies or our global, so Trillium was well insulated there. Moving forward, we remain underweight financials, given some of the interest rate dynamics and now the competitive dynamics, the demand for credit, the supply of credit likely getting constrained, as well as any future imbalances in institutions. We're just going to have to wait and see there, but we want to be cautious in our underweight financials.
In addition to employment being a bright spot, consumers, of course, were as well. How are they adjusting to inflation?
So it's showing up in different ways. In some cases, some of the larger capital purchases prices are coming in where they need them to be. Car prices, for example, softening new and used. On the other hand, food continues to be very stubbornly high, and in some cases moving higher. So it is this bifurcated, non-inconsistent landscape that consumers have to face. Pricing power on wages continues to come down for them. So we will see, especially in a couple of days with debt talks, what programs may or may not be slowed or cut from the federal government. That's going to change the dynamic for a huge part of America as well.
Let's switch gears and go international for a moment here. Europe is expected to be more of a beneficiary as China reopens, but there's also the Ukraine and Russia war going on there. Why do you think that they're going to be a beneficiary, and what's your outlook for Europe?
Yeah, so a couple of things. First, the European economy, there's a lot more direct capital good transfer between Europe and China. Obviously, they also have that in the consumer discretionary luxury goods cycle. So it is two economies that are very, very interlinked, even though the United States has a very big relationship with China. But Europe, it's I would say, more national, more industry specific issue there. First off, Europe got lucky, as many of us did, with weather, but the US dollar weakening substantially also helped some of those stocks rebound in Europe. Overall, recession seems to be holding off. Ukraine, Russia, other geopolitical tensions remain a wild card. Again, back to timelines here, we're only again 14 months from the initial invasion, so you have to be patient. It aligns with us. We're about a 3 to 5 year investor. We're not looking at false signals at this point.
Why do you expect to see elevated company management turnover?
Well, a couple things. One, exhaustion from the pandemic. We're 3 years out, and a lot of companies barely held on or didn't. That takes a human toll. Secondly, some of the considerations from their businesses have changed. Not only supply chains are normalizing, but for us at Trillium as an ESG investor, human capital, how are you treating people? You see a lot of news lately about union talks, a lot of companies across discretionary, transportation, automakers having very serious talks, hopefully substantial, with workers for the first time in many, many years. So that takes a toll on an executive team. We're looking for companies with histories of consistent performance, reasonable expectations with their constituents. But we continue to expect to see that. You've already seen it in Disney, for example, and Starbucks in the last year.
All right, John, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.